Hi traders, welcome to the Ken Tank, where you'll learn how to avoid getting eaten by the sharks on Wall Street. It's always all information for educational use only. I'm not making advice about what to buy, sell, or hold. Hey everybody, in this session we're going to look at how to trade multiple positions and why that's such a benefit over trading large size on single one-shot trades. It should make common sense, but a lot of traders are still stuck in that area where they'll find a magic chart pattern and then make a 1,000-share trade or something over leveraged and then take a big stop, and they get into this negative cycle of small wins and larger stop losses and eventually end up blowing up their trading account. Instead, what I found on some of my biggest winning real money trade days, like $1,700 in the money on a day, is it's much smarter to take a variety of positions rather than just single trades. I'd much rather make, say, $900 with a half dozen or 10 trades that all add up to that, because my upfront risk is much smaller if I'm wrong. For trades that don't work out, even making just a few $100s with a handful of tiny stops, small wins, and even still small wins, they're all small, but it still adds up. That's a good place to get started with as a trader, right? What you don't want to do is trade 1,000-share trades of some penny stocks or some stupid $3 cheap stock that then stops you out. What you want instead is, at least what I advocate, is it's much smarter to trade so that you have many more chances to get it right, and you build up a rack of winning trades and then you add to them incrementally. You can see the quantity share size. This is all under a couple hundred shares each, right? 200 shares, 80 shares, 150 shares, 80 shares. These are in the money trades. That becomes the core or the foundation of your entries and exits. So let's take a look at a few tips I put together for you and how that all works out, at least what I found in my own experience as a trader. First of all, I always say that the math is a lot more important than the chart patterns. So the math of getting modest wins and very tight stops is much more successful potentially than doing 1,000 shares single trades at a time. So being keenly focused on your unrealized P&L and making sure that you're managing the math and doing it carefully instead of large trades that go against you is very important for your progress as a trader. I'd much rather put on 10 trades of 100 shares each and then build the trade over time, whether it's a day or a swing trade. For a day trade, usually I only add at most once additional time. For swing trades, up to 2 or 3 times. But the point is, I may start off a small share trade that I then build into a larger size trade. But everything starts off really small at first, and the reason is to minimize my upfront risk, because I get more shots at getting it right. So as you consider a trading approach that does better for you, one thing that I would encourage you to give some thought to is trade a handful of positions, so you're less committed or less worried and less upfront risk on any single trade. You should always look at opportunities to add to the trades that go in your favor. So you should always look to build the trade over time. You don't take a lot of upfront risk, because otherwise you take big stops and that chews up your account, and you can't afford to do that. So what you need to do, at least what I found, is start everything small and then gradually scale in or add to the winning trades. My goal is to have less than a $200 stop on any incorrect or bad trade or a false breakout that I get into and then it comes back down. I want to stop the loss at no more than, say, a couple $100 as a goal or as a target. And you should set a stop loss target as well. I think what's the maximum heat or pain you're willing to take on any one of your trades, because it's in all of our shared interest, your interest, my interest, your broker's interest, your charting software company's interest, the entire trading infrastructure as a business, as a industry sector. We all want you to win, because that way you can stay with us longer. If you blow up your trading accounts by over trading 1,000 shares or 500 or 2,000 share trades that then blow up, you're not going to be with us very long. So it's in our shared interest for you to make money as traders rather than lose money. So one of the keys to that is making sure you have a clearly defined maximum stop loss dollar cost, not a chart pattern based loss of support, because often, and you know how this goes in real money trades, you often kind of second guess yourself and say, well, kind of a slippery slope, right? I'll let it go a little bit further because surely it'll come back to life. And that's how you lose lots of money as a trader. So I've made that mistake enough times to realize that you got to make your stop loss a dollar-based stop. So if it gets over a couple $100, stop the pain, take a minor stop. If it comes back to life later, then you can always get back in. But generally, good trades are right from the start. So make sure you have a clearly defined upfront maximum stop loss on losing trades. That's important. Now here's kind of the most important benefit of why trading multiple positions. That may be anywhere from 7 up to 15. I've traded many more than that, but you may want to start off with maybe 7 or so, or 10 or something like that. And it gives you a few advantages. The first is it gives you more chances of getting at least a few winners that you can add to. Even if you only, let's say you take 10 trades and you got 5 stops and you got 3 wins and 2 break-evens, at least the 3 winners you can build. And oftentimes if you scale or position size into the winners, that can wipe out the cost of the stops and flip you into the money, right? I didn't know ahead of time which of all these, and these are mostly swing trades, I didn't know ahead of time which of these would be the stop. The biggest stop loss is $70 or $66. The biggest win was only $198, but I still made $1,700 net P&L on that one trading day with a lot of small size. You can see these are all 100, maybe 300 share trade in MGM, but most of them are small share size trades. So play a tighter game, a less expensive if you're wrong game. Like any smart business owner, you want to minimize your cost of doing business, which is what your stops are. Taking small stops correctly is the hallmark of a good professional trader. Taking big stops because you threw Hail Mary passes and bet the farm on a single sure thing, which turned out not to be a sure thing, is the way to blow up your trading account. So none of us want that. We all want you to make money as a trader. So make sure you keep tight stops and trade multiple trades. It's diversifying your risk. Also, one thing that I found, and it wouldn't have been apparent to me until I experienced it firsthand for so many years now, so many thousands of real money trades, I found that I used to be very anxious and worried. If I was in even 300 shares or 500 shares or 1,000 shares, but mostly even just 300 to 500 shares on any given trade, I would worry about it. And I'd check the charts over and over again, right? You know who you are. That's human nature. If you are especially swing trading a stock and you're wondering how it's doing day after day, you kind of check in with the chart more and more often. That tells you you are probably over leveraged or trading too much share size. I don't care how any one trade works out. It's just the next to the next 10,000 trades. Who cares? If I take a little stop, hey, it's a small, a small paper cut. Who cares? I care about how the group of trades does, kind of like a portfolio manager. I look at, how does that 7 or 10 or 15 group of trades perform for me over the near term. So I really don't care about any single one trade. Kind of like having employees. If you got a department and you're looking at your trades as employees, and let's say you've got 15 people in your department, you do you want everybody to succeed, but you realize some of them you're going to have to fire and terminate and let go because their performance isn't where it should be. And so you can't let that drag down your performance as a middle manager or supervisor. If you've ever been in a management role, I used to be a Fortune 500 training consultant, and I worked with a lot of big companies, and we can't get obsessed over the 1 or 2 bad ones out there. We have to focus on performance of the team. And so look at it like a team of trades. Okay. That's important. Also, be less emotionally, it helps you, at least for me, it helps me be less emotionally committed to any one trade, because again, I don't really care. If I'm in 10 trades, I don't really particularly care about how any 1 or 2 particular trades is going to work out. I care about the group. If, however, I'm only in 1 or 2 or 3 positions, I really worry about each one more than I should, and it causes me to take larger stop losses. So what I found in terms of my own development as a professional trader is that it's much more effective to trade a basket of stocks or portfolio stocks. So you have much less percentage of capital tied up also in any one trade as well. Because often, and this happens for those of you who've traded for any length of time, if you get into a trade that you think is really going to work out, you'll often build a position that's so big, it takes up so much of your capital, you don't have much money left to go trade other trades. And oftentimes, 3 or 4 out of 5 others that you're considering really skyrocket, and your trade that is over leveraged doesn't go anywhere or goes against you, right? And so that's one of the errors in trading that I found how to fix, and I like to teach people how to do that in my courses and all that. But you want to be less emotionally and financially committed to any one trade, and that lets you get out faster with tiny stops for any that misbehave, which they will. So you have to plan for that ahead of time. You want to balance your risk professionally. And again, this whole approach is something I've learned with thousands of real money trades of millions of dollars of capital traded over the years. And one of the things that I think is important that you realize that this is in direct contrast with, just as a public service notice, I wanted to mention that at least I personally do not think it's a good idea, nor do I trade those bad, junky, under $5 stocks or penny stocks on large size, like 1,000 shares or 2,000 shares. The reason I say that is I've seen a lot of these young traders out there on YouTube, mostly as social media, trying to say, I made this big fortune trading 1,000 shares of some $2 stock that does a pop and drop like a video game. What they don't tell you about is all the losses, and they conceal that stuff. And so one of the things you need to be especially aware of is it's really a bad idea to trade large size on cheap stocks, because you're going to take big stops and blow up your trading account. I inherit so many traders that have tell me they're reformed penny stock traders or reformed cheap stock traders because they learned the hard way, mostly notably with a lot of stop losses that don't get published out there. That's a very risky type of a trade approach. I prefer charts that have some continuous history and have a reasonably strong trend, right? Things that, personally in the market selling off now, I'm long VXX, right? Those type of inverse ETFs, things that'll run for multiple days. What you don't want is the pop and drop charts. They do this and then they run up, and if you traded 1,000 shares in a 5-minute time frame, you could have made a few $100, but then it promptly gives back most of it and then collapses, and people lose a fortune with those pop and drop type of charts. What you want is what I call an acceleration ramp. You got a steady uptrend that then matures into a nice 45-degree angle, kind of a hockey stick breakout. I've taught so many traders this at my money show appearances and my industry articles for technical analysis of stocks and commodities. Highly recommend both, and more. You want to look for a mature, steady play, not something that's a pop and drop video game, cheap, junky stock chart. So as appealing as it may be, don't buy the hype of people out there on tropical islands trading cheap stocks and all that kind of crap. They're selling the dream. It's not the truth of how most normal traders actually do. You may get an exception, and sure enough, even a broken clock is right twice a day. But what I care about is overall average performance. And what I found is cheap instruments are stupid to trade. I've lost the most money in my own trades on the cheap. It's like the cheaper the instrument, the more money I've lost. Unfortunately, there's not an inverse correlation. I also don't trade, Facebook, Amazon, Apple, Netflix, Tesla, any of the expensive $100 plus type stocks. I like stocks in the $20 to $30, $40 share range. That tends to have the sweet spot of risk and reward and leverage and consistency of chart patterns. So remember, trade the math, not the chart patterns. The first way to do that is to have a maximum stop loss from a dollar standpoint. So remember to diversify. Give yourself more chances of at least getting a few winners that you can build a more substantial position. You may add, for swing trades, I like to add every couple of points or so. For day trades, every 20 to 30 cents. Usually just once. I will add at most on a day trades. And for swing trades, I may add 2 or 3 times every couple of 3 days if the trend continues up strongly. So that's how you build a trade. You want to give yourself a diversified portfolio, and again, look at a team of trades or a group of trades, a portfolio, instead of just doing single trades. So anyway, this is Ken Calhoun. I wanted to keep you on the right side of your trades and give you a better shot at actually making it. Probably smarter to start off with slower term swing trades and occasional intraday trades. And again, I'd much rather put on 10 trades of 100 shares each instead of any single Hail Mary pass 1,000 share trade shoot for the moon, because that's very risky, and for the times that you're wrong, that will cause more expensive stop losses. And your goal is to keep your stops and your small wins close to break even in pursuit of making a few modest wins that start to build over time that you can then scale into. So anyway, this is Ken Calhoun. Hope to see you at my trademastery.com site. We've got a new look, a lot of exciting new features on the way. As the company continues to expand, it's really great, and I thank all of you for finding so much value, celebrating 17 years in business now. It's great to see thousands of you from around the world. We've got a lot in store for the balance of the year, and especially ahead in 2017. We've got lots of new features and exciting, more interactive things on the site to work with and the rest of it. So keep it coming in terms of comments, and I certainly like to hear from y'all, and I will see you in our next episode. So until next time, trade smart, trade tight, and make money out there. Do well. Goodbye, all. Be sure to join my subscribers at swingscans.com and tradingtheopen.com so you can see these types of alerts in each week's markets.